Your portfolio is up 8% this year. Feels good, right? Except inflation was 3.5%, so your real gain? Only 4.5%. And most beginners have no idea this is happening. If you're new to investing and the news is stressing you out, this video is for you because inflation is silently eating your gains, and I'm about to show you exactly how much damage it's doing and what you can actually do about it. Let's start with the part nobody explains clearly.
Inflation isn't just prices going up, it's your money's purchasing power going down. $1 today buys less than $1 last year. Simple. But here's what beginners miss. This doesn't just affect your grocery bill. It affects every dollar in your portfolio. That cash you're holding, losing value. Those bonds, losing value. Even your stocks can lose real value if they're not outpacing inflation. Let me show you what I mean with actual numbers.
Let's start with cash. You've got $10,000 sitting in your checking account just in case. Smart, right? Safe. Except with 3% inflation, that $10,000 loses $300 of purchasing power every single year. After 5 years, it's effectively $8,587. You didn't spend it, you didn't lose it, but it's worth less. A 2024 Vanguard study found that cash holdings lose an average of 2 to 3% of real value annually during normal inflation periods. This is why your parents say save money, but wealthy people say invest money.
This brings us to real returns versus nominal returns. Nominal is what you see on your screen. I made 8%. Real return is what actually matters, what you made after inflation. If stocks return 10% and inflation is 3%, your real return is 7%. That 7% is what's actually building your wealth. According to historical data from NYU Stern, the S&P 500's nominal return since 1928 is about 10%, but the real return, closer to 7%. That gap, that's inflation eating your gains every single year.
Here's why this confuses beginners. Your investing app shows green numbers, plus $2,000 this year. You feel rich, but the app doesn't show inflation-adjusted returns. It doesn't tell you that your $2,000 gain only has $1,600 worth of purchasing power compared to last year's dollars. A 2023 Schwab survey found that 73% of new investors don't factor inflation into their performance expectations. They think 8% gains means they're 8% wealthier. They're not.
Now let's talk bonds. Safe investments, right? You buy a bond paying 4% annually. Feels stable. But if inflation is running at 3.5%, your real return is only 0.5%. You're barely staying ahead. And if inflation spikes to 5%, you're actually losing money in real terms, despite earning 4%. This is exactly what happened in 2021-2022. Bonds paid 2-3%, inflation hit 8-9%, and bond investors got destroyed. Morningstar data showed aggregate bond funds lost 13% in 2022, but adjusted for inflation, more like 21% real loss.
This is why stocks matter. Companies can raise prices when inflation happens. Your coffee shop raises prices 5% to match inflation, their revenue goes up. Their stock reflects that. Stocks have built-in inflation protection that bonds and cash don't. A JPMorgan 2024 analysis found that over 10-plus year periods, stocks outpaced inflation 92% of the time, while bonds only did it 68% of the time. Stocks aren't just growing, they're growing faster than your money is losing value.
Here's where it gets scary. Inflation compounds against you. Year 1, you lose 3% of purchasing power. Year 2, you lose 3% of what's left. Over 20 years at 3% inflation, your money loses 45% of its purchasing power. $1 becomes 55 cents. This is why your grandparents talk about houses costing $30,000. Not because houses were cheaper, because dollars were worth more. This compounding loss is why you can't just save cash. You have to invest to outrun it.
Let's make this personal. You need $50,000 a year to live today. With 3% inflation, in 30 years you'll need $121,000 to buy the same stuff. Same lifestyle, more than double the money required. If you're not investing in assets that outpace inflation, you're planning to be poorer in retirement. A Fidelity 2024 retirement study found that retirees who didn't account for inflation ran out of money 12 years earlier than those who did. 12 years. That's not a rounding error. That's a crisis.
If this is making sense, hit subscribe. This channel is for beginners who want calm, not hype. All right, so inflation is eating your portfolio. What do you actually do about it? I've got 3 strategies that work, backed by data. The first one is something 90% of beginners aren't doing. Let's get into it.
Strategy 1. Keep the majority of your long-term money in stocks, not bonds or cash. Stocks have historically been the best inflation hedge. From 1928 to 2024, stocks delivered 10% nominal returns. Even during high inflation periods like the 1970s, stocks still averaged 6 to 7% real returns. That's after inflation. Not amazing, but positive. Cash and bonds during those same periods, negative real returns. You were guaranteed to lose purchasing power. Stocks gave you a fighting chance.
Let's talk about the worst-case scenario, the 1970s. Inflation averaged 7.4% per year. Brutal. Stocks still returned about 5.9% annually, negative 1.5% real return. Not great, but bonds returned 5.5% with 7.4% inflation. That's negative 1.9% real. And cash and savings accounts, negative 3 to 4% real returns. Even in the worst inflation decade, stocks lost the least. A 2023 Vanguard study analyzing 90 years of inflation periods confirmed stocks are the least bad option during inflation. Not perfect, but best.
Strategy 2. Increase your contributions with inflation. If you're investing $500 monthly now, raise it by 3% next year to $515. Match inflation with your inputs. This keeps your purchasing power consistent. Most people invest the same dollar amount for years, not realizing it's getting weaker. A dollar invested in 2025 is stronger than a dollar invested in 2035. JPMorgan research found that investors who inflation-adjust their contributions build portfolios 23% larger over 30 years compared to those who don't.
Strategy 3. Consider dividend growth stocks or funds. These are companies that raise their dividends annually, often faster than inflation. Johnson & Johnson has raised dividends for 60-plus consecutive years. Coca-Cola, 61 years. These companies naturally adjust for inflation by increasing what they pay you. A 2024 Hartford Funds study found that dividend growers returned 10.2% annually from 1973 to 2023, while non-payers returned 4.3%. That gap? Inflation protection built in.
Real quick, gold and crypto. People call them inflation hedges. Are they? Gold's track record is mixed. Sometimes it keeps up, sometimes it doesn't. From 1980 to 2000, gold lost 50% of its value after inflation. From 2000 to 2020, it beat inflation. Inconsistent. Crypto? Too new to know. Bitcoin has existed through only one major inflation period, 2021 to 2023. It crashed. Maybe it'll work long-term, but we don't have decades of data. Stocks have 100 years proving they work. Gold and crypto? Speculation, not proven solutions. But drop a comment and let me know what you think.
But what if we get deflation? Prices falling instead of rising? Great question. Deflation has happened exactly once in modern U.S. history, the Great Depression, and it was catastrophic. Stocks crashed 89%, but then recovered. Holding cash during deflation is good short-term, but terrible long-term, because economies don't function in deflation. Governments print money to fight it, which brings back inflation. Your strategy shouldn't change based on a once-in-90 years event. Plan for the 99% scenario, inflation, not the 1% scenario, deflation.
Let's destroy a myth. High-yield savings accounts beat inflation. Current rates? About 4 to 5%. Sounds good, but that's taxable income. After taxes, maybe 3 to 3.5% real return if you're lucky, and those rates drop when the Fed cuts. Meanwhile, inflation averages 3% long-term. You're barely breaking even, and only temporarily. A Bankrate 2024 analysis found that savings accounts have matched or beaten inflation in only 12 of the past 50 years, 24% success rate. Savings accounts aren't wealth builders, they're parking spots.
One more thing. If you think U.S. inflation is bad, check globally. Turkey hit 85% inflation in 2022. Argentina regularly sees 50 to 100%. Venezuela went over 1,000%. Americans complaining about 3–4% inflation don't realize how good we have it. But here's the point. Stocks in those countries still outpaced local inflation better than cash. It's universal. When money loses value, owning pieces of real businesses that produce actual value is your best protection. This isn't U.S.-specific advice. It's economic reality.
Here's your action plan. 1. Check your asset allocation. If you're young with 20+ years until retirement, you should be 80 to 90% stocks, not 50-50 stocks and bonds. 2. Set up annual contribution increases of 3%. Make it automatic. 3. If you're holding more than 6 months' expenses in cash, invest the excess. That money is actively losing value. Inflation isn't coming. It's already here. It's always here. Your portfolio needs to be built for that reality.
Look, inflation is the silent killer of wealth. It doesn't crash your portfolio dramatically, it just slowly, quietly makes everything you own worth less. The good news? You don't need complex strategies. Stocks, regular contributions, time. That's it. The investors who win aren't the ones who beat inflation by 10%, they're the ones who beat it by 3 to 4% consistently for 30 years. That consistency turns into massive wealth. Drop a comment. What's your biggest inflation concern? And if this helped, share it with someone who thinks savings accounts are enough. See you in the next one.